Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Brian Burke. He is the president, CEO of Praxis Capital Incorporated. He is a vertically integrated real estate private equity investment firm, which he founded in 2001. Brian has acquired over $800 million worth of real estate over a 35-year career, including over 4,000 multifamily units and more than 700 single-family homes with the assistance of a proprietary software he wrote himself. Brian has subdivided land, he's built homes, and constructed self-storage, but really prefers to reposition existing multifamily properties. He's the author of Hands-Off Investor, an Insider's Guide to Investing in Passive Real Estate Syndications. And yes, Brian, I brought the book. And is a frequent public speaker at real estate conferences and events nationwide. So, Brian, I've been looking forward to this. Welcome to the show.
Me too, Keith. Thanks for having me here.
Yeah, absolutely. I'd like to start, you've got such a long career, and I really want to dig into that. I personally have found your book just extremely helpful in understanding syndications from somebody who is inspiring to do that myself. And so I've heard a lot of and looked at a lot of the things that you've kind of warned about that some folks have done and seen the structures and all that good stuff. But I really want to start with the beginning. Where you got started with real estate, maybe where you grew up and what led you to real estate.
Well, I grew up in Southern California, and then as a teenager moved to Northern California. And straight out of high school, I had this strange epiphany that I should try investing in real estate because I knew nothing about real estate and I had no money and I didn't know anybody that was in real estate or could teach me anything. So sounded like I had the perfect combination. Why not give it a shot, right?
Yeah.
And kind of as they say, the rest is history. I started that. I was 20 something years old and really never looked back. And 786 properties later, I'm still doing this.
Yeah, that's incredible. So where did you start when you started with real estate?
I started as a house flipper, here in Northern California, buying houses, fixing them up, and reselling them. And I found out early on in my career that even though I was, 22 years old, I looked like I was 15. And no one is going to sell their house to who they think is a 15-year-old. So I figured the only way I was really going to be able to be successful in this business is if I could buy houses at the public auction on the courthouse steps where foreclosures were being auctioned off. Because there, nobody could say no. All you had to do was be the highest bidder and you could buy property. And so I decided that was going to be my route. And it really has been. I think I've bought about 700 of the 780 properties I bought at the courthouse steps at public auction.
That sounds good. How far did that flipping career span?
Well, I'm actually on a very limited basis still doing it today. So 35 years this year. It's been a while.
Yeah. Interesting. And you say you still do it today. Are you doing it with some partners? Or are you doing it yourself? A lot of folks, it seems they may start there, but they don't necessarily continue it. But obviously, it continues to be a source of income. So,
Well, I had an unusual situation in 2009 and 10 when the real estate market collapsed. That was a really unique time for me because as a foreclosure investor, there was never a time when there were more foreclosures. So I built quite a systematized business around our flipping business at the time, and I installed a whole team to handle all of that. And I still have just enough people left in the team to do the volume that's available out there. So that's the only reason I'm still doing it, is because I have the people for it. It doesn't really take any of my time. If it was me out there, going to Home Depot to buy appliances and put them in a U-Haul truck, I'm not going back to that.
right. Makes sense. And when did you go from that into investing in, say, multifamily?
It was about 22 years ago. I decided that I should give multifamily a try. It was a time when I felt like I had gotten pretty good and pretty systematized in our house flipping business. And I was, of course, you go to the seminars that talk about, one roof, one lawn to mow and all that stuff. You're like, well, that sounds pretty good. I should figure this out. So I got started by buying my very first multifamily property. It was a 16-unit property in California, fixed it up and raised rents and did all that stuff, and kept it for, I think I owned that property for 15 or 16 years before I finally sold it. But that was my first foray into multifamily. And from there, it just grew like wildfire.
So on the first one, was that all your own capital that you put in? At what point, I guess, did you start raising capital for some of these?
That was my capital. And I did that on a 1031 exchange by selling a couple of rental houses that I'd collected through the virtue of my flipping business. And, I'm a kind of person, I like to try things out with my own resources and get good at it and really understand it before I put investor money to work in that strategy. Because the last thing I want to do is lose someone's money. And knock on wood, I've been doing this with investor money for 23 years now, and I've never lost a nickel of investor principal. And I think in part because I learned my lessons the hard way, and I learn them on my dime.
Yeah.
So at first I did that. And then it was a number of years later where I did my first apartment syndication. Gosh, it was maybe almost as many as 8 years later when I did my first apartment syndication.
Okay. And between the first apartment that you bought with your own capital and the one that you syndicated some 8 years later, had you bought any additional ones in between that, or what did your investing look like between that first one?
I had, and that's where I started getting my out-of-state experience. So the next thing I did was started buying, duplexes, fourplexes, small commercial multifamily, mixed use. I bought my first out-of-state property all the way over in New York from California. So that was a unique experience. And that's how I learned to really broaden my horizons and understand, markets in other areas. Because at that point, California was just getting really overbought. And it was my feeling that there was really no really good excuse to buy property in California anymore. So it was time to expand my horizons and broaden out a little bit.
Yeah. What did that look like exactly, Brian, when you started investing in other states? Did you have to build a team out there? Did you invest with other investors out there, or what did that look like for you?
Yeah, I just had to build a team. It's like you start with nothing, and it's interesting how it's always just a series of introductions that lead to other introductions. And through a real estate agent that I had worked with, I got connected with an agent out there who connected me with a property manager, who connected me with a contractor, and connected me with an insurance broker and an attorney, and just, kind of just one by one built out the whole team. And then when it was time to buy, I had everything already in place.
Okay. All right. And so I guess tell me a little about that first one that you did the syndication on. Give us a little idea of what that deal looked like.
My first syndication was a total disaster. I bought this 60-unit building in 2008, and I bought it for half of what the last guy paid for it, and it was in foreclosure, and I bought it from the bank through the foreclosure, and I thought I was getting a great deal because I paid half of what he paid. That sounds pretty brilliant. Then what happened was about 6 months went by, and during that 6-month period, I'd managed to renovate a good number of the units, renovated the outside, raised rents significantly. I got the place to about 99% occupied. I think I had one vacancy, and that was leased, and it just hadn't moved in yet. And then the bottom fell out of the economy in 2009. And that's when Bear Stearns collapsed and Lehman Brothers collapsed and the banking industry was collapsing and everything was falling apart all around us. The end result, of course, of all of that was that people were losing jobs, and that meant that they were moving out of their apartments or staying in them, but not paying. Right. And I used to joke that, that half the units were empty and the other half weren't paying. And it wasn't quite that bad, but it sure felt that bad.
Yeah.
And it took a long time to, kind of dig out of that, right? I mean, came to a point where the income was enough to pay the property's expenses, but not enough to service the loan. So I started trying to figure out, like, okay, I got this $15,000 a month loan. What do you do? Do you hand the keys to the bank? Do you let them foreclose? You give it back? You file bankruptcy? How do you get out of a situation like that? And my only solution I could come up with that was viable was, well, I'll just make this next mortgage payment out of my pocket. I'll take the $15,000 out of my pocket. I'll make the mortgage payment. How long could this possibly last, right? So I did that thinking it would be, a couple months, 2, 3, 4 months. It turned out to be over 3 years. I made that $15,000 a month mortgage payment. And then finally the market started to come back. And rents started to increase, and occupancy started to increase, and property values started to increase. And I think it took 6 or 7 years before I was finally in a position where we could sell that property for a profit, return all investor capital, pay myself back all the money I loaned in for mortgage payments, and even give my investors a little small return. That was a long, long road and a really hard way to learn about apartment syndication.
Yeah. Yeah. So right after you did that, you thought, gosh, I better do another one.
Yeah, I better do like a lot more of this. It's funny when you have an experience like that. I guess if you're a glutton for punishment, you just keep going. And I must be one, or otherwise I wouldn't have kept going. But one thing that I think, is really the valuable lesson and the takeaway was that if you handle it right and you do right by your investors and you protect your investors, it's interesting how word gets out. Your reputation is really made during times like that. And people were coming to us wanting to invest because, word gets around of like, oh my gosh, you did that. Okay, well, I want to invest with you because, these other guys, they just stole my money, or just let the bank take it back. I mean, a lot of people that were doing apartments back then were letting the banks take back their properties. I know this because I bought a lot of those properties.
Right. Yeah.
So I feel like, you really learn who someone is when the chips are down. And that was a good opportunity for my investors to really learn who I was. And that really fueled our business. Had that not happened, I probably wouldn't be where I am today.
Yeah. What were you, so that, I mean, obviously a $15,000 mortgage payment's huge. Were you still at that point, what were you doing for income? Was it coming out of savings? Was it, how were you making that payment?
That's a great question. And it was really the one saving grace that I had is, if you remember, kind of early in this conversation we just had, my business, my real business at the time, or my kind of first business, so the biggest part of my business was house flipping.
Right.
And during that 2009 to 2012 period was the busiest time I've ever had in my house flipping career. We were doing like over 100 houses a year. And thankfully that generated enough income to put me in a position to be able to do that. And this kind of goes back to I think there was a book out there. I can't remember the name of the book. It was called like Multiple Streams of Income. I couldn't quote you a word out of the book, but the title sure as hell makes a lot of sense, right? If you have multiple streams of income, you can flatten out some of that volatility. And when one thing isn't working, if something else is working, you can stay afloat.
Yeah, for sure. And it's interesting. You were right in the middle of it when the market shifted last time. And what parallels do you see now? And obviously, you mentioned buying apartments from people that had lost them, that had handed the keys back. There's a little bit of that going on right now, or maybe a lot of that going on right now. There's a lot of people that were new to the game that, jumped in and, for a little stretch of time there, which I'm sure leading up to 2007 was probably similar in the sense that, you could buy something and maybe not have to get it 100% right. You could come in and say, well, it's going to go up in value. We're going to raise rents. And you look like a genius there for a few minutes. And then all of a sudden, the market shifts. So just curious what you see as far as parallels. And do you see some of the same types of scenarios that you saw back then with, different syndicators?
Yeah. There's always these periods, these windows of time where even the worst operator can acquire real estate, improve it, resell it, and make mountains of profit. But yet they could do nothing different in a different window of time and lose it all.
Yeah.
So the profit that they made wasn't necessarily a result of their acumen, their skill, their ability to manage or acquire or renovate, any of that stuff. It was just that they got into the right time and they were able to get out before the music stopped. So that certainly is a very true statement. That was happening a lot in the early 2000s. I remember standing on the courthouse steps with other investors as we're waiting for properties to get auctioned off, which didn't happen very often during those years because there are a lot fewer foreclosures during that period. But as the years ticked on and we got closer to like 04, 05, the running joke was, there may not be much to buy right now, but give it a couple of years, there's going to be tons of stuff. There's going to be an avalanche of real estate and no one's going to want it. And that was exactly what happened ultimately. And, now here we are finding ourselves in the same position again. So this should come as no surprise that investors went and cleaned house on acquiring multifamily assets between 2021 and 2023. And now their loans are coming due because a lot of these were financed with 3-year bridge debt and the loan maturities are coming up and they have no exit. No one wants to give them a refinance loan. And even if they did, the interest rate would be double what they had. No one wants to buy it unless they're paying less than the loan amount, in many cases, far less than the loan amount. So we're finding ourselves, here history is kind of repeating itself again. Now, each time it looks a little bit different. In 2009, the malaise in 2009 was caused by job losses, and economic forces, macroeconomic forces that put residents in a position where they couldn't afford their apartment, they didn't have income at all, or they had to double up and live with friends or family. Occupancies were falling, rents were falling, bad debt was increasing, all those things were happening. And that caused that real estate to tumble. And now here we are in this cycle. It's 2024 as we're recording this. And it's a completely different cycle with a similar effect. Now what you have is high interest rates that threw borrowing costs and the cost of capital in general into the stratosphere. Yet at the same time, occupancies are holding up quite well. Rent growth has stopped and turned slightly negative, but certainly not like a falling knife or anything like that.
Yeah.
So fundamentally, real estate is actually in a pretty sound space. Part of what's happening in multifamily in terms of, falling rents is really a function more of two things. One, they went up way too high, way too quickly. So rents in some markets went up 40% in 2 years. So you would expect that they overshot and they're going to have to come down just a little. And the other is that there's been rampant development when low interest rates were there, and there was a lot of demand for units. Developers took notice, called their architects and their land brokers, and got going. And only now are we seeing the end result of all those efforts when the apartments are getting finished and being released to the market at the worst possible time. So, so now you have a little bit of different forces at play, but still causing pain for some owners.
Yeah, for sure. That's interesting. And with, I guess let's go back to the syndication. So after the first one that you did, then what did you acquire? How soon did you acquire the next one?
So it was about 2 or 3 years before I started acquiring more. It was around 2011, I think. About 2011. And that's when I really started acquiring a lot, 2011, 2012, 13. And ever since then, we've acquired about 4,000 units during that period, with probably about 3,000 of those units occurring kind of in the 2015 to 2020 space.
Okay. And what did you look at differently, or what appealed to the next one that you did? This first one's bleeding and taking quite a bit of a beating, and demanding capital. What did you do differently, maybe on your underwriting on these next ones to be able to anticipate that? Obviously, pain, you can learn from the pain that you've inflicted, but
yeah. So there's two primary differences. One, in the underwriting side, I really learned how to underwrite properly to anticipate bad debt loss, vacancies, concessions. When you're in an adverse rental market, you see how bad it can really be. And that gave me a really good opportunity to learn how to navigate how bad it can really be, and underwrite and anticipate for how bad it can really be. And if a deal works after underwriting for some really bad stuff, then you can most likely survive if your financing structure is right. So that was the other thing that we did differently is when I bought that first one, I was really aggressive on financing, because, when you're first getting started, you don't have a lot of access to capital, and, you really try to maximize debt leverage to, buy the most you can buy with the least amount of money. Right. And learned that that's not any fun. It's a lot more fun to buy what you can buy with a lot of capital and have as little debt as possible and as long of a debt maturity as possible. And that's really how we focused our business after that period. And that's made all the difference in the world. I think, right now, being a lower leverage operator makes life a lot more calm during times such as this. It makes it difficult to raise capital because investors are like, well, your returns are only projected to be 14%, but so-and-so's returns are projected to be 21%. So I'm going to go invest with them. And, of course, we watch all these investors go into those deals and just thinking like, you're in an airplane crash waiting to happen. And of course, that's exactly what happens. There's a picture behind you of a DC-3, which is a twin engine airplane. And there's an old saying in aviation about twin engine airplanes that says that when one engine fails in a twin engine airplane, the second engine will fly you to the scene of the crash. Right. And that's kind of what has happened in a lot of these multifamily syndications, is those 21% returns flew these investors to the scene of the crash. Meanwhile, we're still out here, and we're going to survive and not lose our investors' money and all that sort of stuff. And that's the lessons that you learn when you go through an adverse market.
Yeah. Tell me a little bit about the leverage, and what has been, and where do you kind of keep it as kind of the safeguard?
There's two pieces or two measurements that I think are really important. One is the loan to value ratio. We absolutely keep it below 75%, but we usually are below 65%. I think all of the assets we have right now, our highest loan to value ratio when we acquired it was 65%. Some of them were even lower. And then the other measurement is the maturity. the biggest risk out there in commercial real estate finance, and for listeners that aren't aware of this, when you finance your single family home that you live in, you go get a 30-year fully amortized fixed rate mortgage, and then you never worry about it again. You can make your payments every single month until the whole loan is paid off, and then you own your house free and clear. You can also sell your house in 2 months and pay the loan off, and you'll have no prepayment penalty. But commercial real estate finance doesn't have an equivalent to that. So in commercial real estate finance, you almost always will have some kind of shorter term maturity where the loan never fully pays off and you have to refinance it. Those maturities range from 3 years, 5 years, 7 years, and 10 years. Those are the four primary options. The people who are in the most trouble right now are the ones that did 3-year loans, because 3 years ago, the market was hot and heavy. Now it's not so good. And guess what? 3 years went by. So now their loans are maturing and they have to pay them off. And that means you either have to sell or refinance. And right now they can't do either. So they're stuck. All of our loans on the properties that we have left. Now I sold 3/4 of my portfolio at the very top of the market in 21 and 22. So I don't have much left, but we still do have about 1,000 units left. All of those have 10-year loans. So I don't have to worry about a loan maturity or anyone knocking at my door saying, you have to sell. Because that is, in all of commercial finance, to me, that is the biggest risk you have, is having a loan maturity occur during an adverse cycle. The longer the maturity you get, the more chances you have to ride through an adverse cycle and sell when the cycle is good. Now, if you do get to year 10 and you do have an adverse cycle, after 10 years, you've probably got a lot of equity built up, and and the values have probably gone up quite a bit where you can still get out and come out okay after 10 years.
Yeah, that's a good point. To think of how long that you have to kind of ride out this cycle, and I love the fact that 75 to 65% makes a whole lot of sense, and it does allow you to sleep significantly better. What about the debt coverage ratio? What do you typically? I know lender is going to require a certain amount, but is there anything specific you look at there?
Not really, because that's a lender measurement. I know investors like debt service coverage ratio and lenders like debt service coverage ratio. I don't spend a lot of time stressing over debt service coverage ratio when you're taking out your loan, because the lender's going to make sure that it doesn't fall below. Now, you can go and get bridge loans where they have a requirement of 1-to-1 debt coverage ratio, or maybe even less, where the income doesn't even pay the interest. I'm never doing that. Every time that we're buying, we're using lower leverage and longer term debt. So our debt service coverage ratios will always be above 1.25 when we start. And generally, what I found, I think on our entire portfolio when we acquired, they were in like the 1.6 to 1.7 range.
Okay. And what about with your investors? And I don't know if this strategy has changed over the years, but when you're raising capital from investors, how long are you anticipating or staying in the deal? Obviously, back when rates were good, there was an opportunity once you turned it around to be able to refinance and return some of the investors' capital. But what are you typically looking at with your investments?
So if we can refinance in 3 years and return some investor capital, we're happy to do that. And if that's accretive to the return, doing that accomplishes two things. One is it mitigates risk to an extent because you're able to give some money back. They can't lose money from a deal that they have back in their bank account already.
Right.
So there is some risk mitigation with refinancing and returning capital. You also can juice the return by doing so. What we don't do is we don't underwrite to that as our standard. So this was a common practice for a while with a lot of operators. In fact, we used to even do it for a while, where you would underwrite to this cash out refi where they're getting X% of their money back, but you're holding for, however long. And then that's going to help boost the return. Instead, I just approach it a little bit differently. And we tell our investors that, we're buying for a 3 to 5 year hold. We have a 10-year loan, so we have plenty of time. If during that period we can refinance and return capital, great, we will, but we're likely to only do that if we get to year 3 and we don't want to sell. More often what I've found is by the time you get to year 3, you're just better off selling. And so we've only actually refied and returned capital, I think once or twice in my entire history. Most of the other deals we've just sold and gotten out. Because I just believe there's no better way to mitigate risk than to make a big, huge profit and put the profit in your bank account.
Right. Speaking of profit in the bank account, so you sold a bunch of your stuff. What did you 1031 it? Did you what was the plan with that capital?
No, because when we sold, I was sensing that we were at the top of the market and that the market was going to, not crash. It has, but I didn't think it was going to crash, but I certainly thought it was going to weaken at the very least. And I wasn't interested in acquiring additional assets. I wanted to wait until the market did whatever it was going to do, and then we can come in and buy again. So no, we completely cashed out. We returned capital to investors. All that money went back in the bank. People did whatever they wanted to with it. Maybe some of them invested in other syndicators. Maybe some of those are doing really well. Maybe some of those aren't doing well. I don't know. But no, we cycled completely out, and then now we're just waiting for the right market conditions to get back in.
Okay. And on the proprietary software that you had, was that proprietary for your multifamily, or was that with the flipping business?
It was for both. The first one I did was for the flipping business, and that's how I learned to do this stuff. Is when I started doing this, it was 1989, and the internet had just kind of first become a little bit popular. Email had just become a thing. And I would go out to the auctions that I would, you cut the notice out of the newspaper and you have it you tape it to a piece of paper and you go out to the auction, and then everybody else out there was fumbling through papers trying to figure out what's going to auction next, or where did that one go, or I didn't know that was going to sale. And I thought, there's got to be a better way. So that's when I wrote my first software program, was designed to track all of the foreclosure sales in our area and to assist me in doing title searches and automatically prioritize liens, help me calculate max bid amounts and renovation budgets and all that stuff. So I would know more and have better information than anyone else at the auction. And it worked remarkably because we were buying stuff where people would look at each other and go what was that? So that was the first one. And then when I got into multi, started looking around, trying to find a good underwriting platform. And I wasn't finding what suited my needs for the way I approached this business, and said, well, what I found with my flipping business was the best way to get the best tools is to make them yourself, because no one knows what you need better than you do. So I created my own underwriting platform on the multi side, and I spent probably about 2,000 or 3,000 hours working on it over a multi-year period, perfecting it. I think I'm on version number 120, and I think the first 300 versions I didn't track. so it was a lot of development over a long period of time. I haven't touched it actually in quite a few years now, because I think I finally got what I was looking for.
Good. What are some of the what are some of the tweaks that you made along the way that you said, man, this is great, but what if we what if we calculated for this, or what if this would make it better if we did put in these assumptions? What were some of the changes?
What usually would happen is I'd find myself in a deal with something unique, right? We wanted to do a different profit split structure. So how do we create a module that would allow this kind of profit split structure? Or, what if we took on a slice of preferred equity? Well, how do you track that money that goes in, and then the payments that go out, and the the back end accruals, and how do you factor that in? Or what happens if you have a joint venture equity partner who brings in one slice of capital that's investing pari passu with a syndicate with a bunch of other investors in another slice of capital, and they might have different waterfall structures for the two different investment buckets. Just like there's just so many different things that each time you get into a deal, you're like, oh, our model can't calculate for that. So let's build that. And I would build that and add it in. And of course, now you get all these different modules that now we could do almost anything. And, like a loan assumption. What if you're doing a loan assumption instead of a new loan? And how do you factor in the debt that was already there with its current loan balance and the number of interest-only months remaining, and the month that's going to come due, and any prepayment penalty. There's just so many things to think about because there's so many nuances to real estate that to have software that kind of can handle all those variables takes a lot of work.
Yeah, for sure. What you mentioned waterfalls in there, and just curious if those if have changed at all throughout. Yeah, obviously from your first one, but or maybe your first couple. But what structure are you really kind of comfortable with now? Saying, this is fair to the investors, this is fair to us as the operators. Can you share some of that, and maybe for the benefit of the audience who may not be familiar with what a waterfall is? You wrote the book on it, so.
Yeah, you're right. I did actually. So yes, you're right about the first couple deals were a little bit different, but once we settled into a formula that really worked, we've stuck to it. I would say, the last, few thousand units we bought all had the exact same waterfall. Every once in a while, we have to tweak what that looks like because, if we did like a, some kind of ground up development deal or, just something that's different, then the waterfall structure term should be a little bit different. But what the waterfall is, it's basically the profit split. It means that, for finding the real estate, managing the asset, managing the sale of it, putting all the investors together, our compensation for that comes from two sources. One is some fees and the other is a profit split. And the idea is you want the majority of your income to come from a profit split so that, as you perform and do well for your investors, then you do well yourself. And so the structure that we use almost exclusively now is an 8% preferred return, which what that means is that investors get all of the distributed capital and we get nothing until they've reached a cumulative 8% return on their money. After that happens, we have 3 different waterfall hurdles. And what that means is that once the 8% has been paid, any money that gets distributed after that point is split partly to the investor and partly to our company. And that split starts at a 70-30 split where the investors get 70% of the profits and we get 30%. And that continues to happen until they reach a 12% return. Once the 12% return has been satisfied, then we have a 60-40 split with the investors getting 60% until they reach a 15% return. And then after they've reached a 15% return, we split 50-50. Now, that doesn't mean that if you get a 15% return, we go back and we're splitting everything 50-50 all the way from the first dollar. We're only participating 50-50 in dollars that are distributed after you've already been distributed a 15% return under the terms of the previous waterfall tiers. Now, it all sounds pretty complicated, but the whole idea here is that if the investment underperforms, the investor gets very favorable treatment by virtue of this preferred return where they get all of the distributions until an 8% and larger percentages of the distributions at lower rates of return. But if the deal overperforms, then we as a sponsor get rewarded for what we would like to think is our efforts, but could be our luck for having produced a really high rate of return for our investors. Then that's when we participate at a greater level. In theory, it's designed to incentivize us to produce higher returns for investors. Now, I suppose it could be argued the opposite, that it incentivizes you to take outsized risk. So, with everything, you have to make sure that you're really considering all the factors.
Yeah, that's a great point. And your book is great for anybody. Well, like I said before, anybody who's aspiring not only just to understand, the syndication world, but also for the passive investor, right? It's for that person that really wants to understand what's going on in the back, in the back end. What are the questions that I need to be asking? That kind of thing. So, with a passive investor, what are some of the ones that you feel are just maybe things that get overlooked? You kind of already have mentioned one, and they're just kind of chasing the return that's on the slide deck. Oh, so and so's, saying they're going to guarantee X amount, or they're anticipating X amount, and you're showing something a little bit lower. But yeah, if you could maybe speak to that a little bit.
Yeah, The Hands-Off Investor was written as a guide for the passive investor. It's just kind of a byproduct of the book that those who are providing passive investments are also finding themselves learning a lot out of the book. But it was actually written for those who are writing checks to someone else to say, I'm going to invest in your project, but I want to know what I'm investing in. I want to know how it works. I want to know if this is a good decision for me. That's the audience this book was intended for. And some of the key emphasis I think I'd place on what investors should look for is, first of all, betting on the jockey more than the horse. Who is really running this deal, and what experience do they have, and what's their integrity, and what's their experience, and what's their track record? How many times have they done this before, and have they ever survived an adverse market cycle? I mean, those are big things that you really need to look at as a passive investor to make sure you're investing with the right group, because a good investment sponsor can make a great deal, or even better, and could take a bad deal and turn it around. But a bad investment sponsor could take a great deal and destroy it and lose it in foreclosure. So it's really important to invest with the right people. That's the first key takeaway. The second key takeaway is to look at the way the deal is structured. What's the financing look like? What risks are you taking? Because, with any real estate investment, when that property sells, there's always someone else that's going to get paid before you. And that is, in any circumstances, the lender, right? The lender's going to be the first one to get paid. And if there's preferred equity, they're in second line. Or if there's a second mortgage, they're second. Preferred equity's third. And then you're fourth. So it's important to know, where do you fall in the food chain, and what risks are you taking by the structure of the debt and the structure of the equity. It's really, really important to understand that, because that's where investors are really getting bit right now. I think the third thing that you really need to pay attention to as a passive investor is just making sure that the business plan makes sense, the underwriting makes sense, the rental comps and sales comps and all that thing really checks out. And I spend a lot of time and emphasis in the book on how do you even understand those concepts, and how do you understand what's good and what's not good.
Yeah. Interesting. And what are some of the things that you see, maybe with other operators, that are kind of common mistakes? Things that maybe they, maybe I'm sure you've seen enough out there with others, But what are some common mistakes? Where do people go wrong?
Over leveraging is a big one. And this is kind of like dovetailing onto what investors should be looking for. That's one more, is invest on a risk adjusted basis, right? It's like, don't just go chase the highest return. And the highest return is just a number in a booklet that you're going to get handed by the investment sponsor. And to get you to invest in that, the higher the number, the more chance you're going to invest. But to get the higher number, the sponsors have levers that they pull on to get there. And this is where the mistakes are made. One of the levers is they take on a lot more debt. That's a lever. Another is they use a lot of preferred equity, which is a different source of equity financing for the deal, but it comes at a higher cost than the debt, and it's in a priority position over you as an investor. It can juice your return, but it also can cause you to be wiped out. So that's another one. Another one is they get aggressive on their assumptions, whether that's their income assumptions, rent growth assumptions, post-renovated rent assumptions, expense assumptions. Any of those assumptions can get thrown off. And another big one, of course, is their resale assumptions. They might be promising a really high return because they're using a really highly inflated potential resale price at year 3, 4, 5, 6, or whatever. And if that is pie in the sky and never materializes, then you never get that return. So the only way to get those really big returns is either they buy the property really super cheap, which is difficult to do in a market with as much competition as there is out there, or they have to financially engineer their way into those higher returns. And that usually means they're making a mistake somewhere along the line.
Yeah. Okay. Well, this has been really, really good. And I've got a million other questions, but I want to be respectful of your time. First of all, I guess, how can people find out more about you and if they want to invest with you? Are you still actively? I know you mentioned that you're, currently kind of have a lot of cash on the sidelines, maybe waiting for that opportunity. But where can people find out more about you if they want to invest?
Yeah, we haven't bought anything in over 2.5 years, and it might be another half a year, 1 year, 1.5 years, 2 years, 2.5. I have no idea yet how long it's going to be, but I can assure you that when the time is right, we'll be buyers. And if you want to know more about when that happens, you can contact us through our website. It's praxcap.com. It's praxcap.com. You can click on the Let's Talk button, and our investor relations team will set up a phone call with you and get you in our database. Also, you can follow me on Instagram at Investor Brian Burke.
Fantastic. And I've got 2 more questions for you, Brian, that I ask every guest. The first is just really, if you have any advice you would give somebody who's maybe just starting out in their investment journey.
Yeah, I would say don't feel like you have to go big or go home. It's perfectly acceptable to start small, make little real estate investments, get your skills really sharpened, and then work your way up into larger properties. All too often I see people say like, well, I'm going to buy my first property. It's going to be a 20-unit apartment building or a 100-unit apartment complex, the crazy things you hear. Don't get lured into that.
Yeah, that's great advice. How about a book recommendation? Obviously, I'll make this book recommendation, but besides this, and it doesn't have to be real estate related, but just something you've read recently, Brian, that's been impactful.
Well, I can't say it's been recent because I haven't, up until very recently, I haven't even had time to read a book. And now I don't even know if I have the attention span to read a book anymore. But, some stuff that I've read long ago, of course, everybody's read Rich Dad, Poor Dad. That's a great book. It really helped me kind of like develop my mindset. I liked this book called Real Leaders Don't Do PowerPoint because it tells you, it teaches you things about how to present your ideas. And another one along that line is a book called TED. It's like the TED Talk guy that wrote it. Mm-hmm. And that teaches you about making presentations because a big part of this business is getting other people on board with your idea. And if you can't effectively communicate your idea, you're never going to get them to join you. So learning how to present your ideas, I think, is a very critical aspect of investing in real estate that a lot of people don't think about.
Yeah, that's great. All right. Well, this has been awesome. I really appreciate it, Brian. I'm glad we had a chance to do this. Thank you so much for being on The Wealth Flow.
Thanks for having me on.
Yeah.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.